there's a certain psychology in the markets that once you start seeing a lot of headlines saying, hey, things have changed or things are going to change, it becomes self-fulfilling at some point.
I did 2 weeks ago spend a few days in Montreal at a Canadian appraisal conference and Appraisal Institute of Canada's conference, actually in no way connected to the Appraisal Institute of the U.S., which I was shocked to learn several years ago. Episode 44 of Market Moves with Mark and Jeff. These continue to be interesting times, maybe a little pathetic at times too, Jeff. Nothing says interesting and maybe a little pathetic than Klarna's willingness to finance $35 Chipotle orders in 4 easy installments. Have you seen this news?
I've seen the news. In fact, I just heard an article about it recently, and boy, it's so interesting to see. On the one hand, you've got, kind of clever business people looking to provide a service. But on the other hand, man, if there's a demand to finance the meal that you're eating out, I don't feel very good about the state of things at the moment.
The memes are a lot of fun. I've seen them all the way through, and I wish I could remember them right now. But yeah, it's just wild times that such a fast-paced, changing world is bringing. That's a pretty good symbol of it, I think. But we'll jump right in and start talking a little bit about housing here this week. I think the high inventory rise, pressure on sale prices is really starting to hit us. And we've seen a lot in the news the last little bit here. And there was a chart that I pulled up from NAR that I thought was interesting and would be great to have up here. But this chart here is showing that we are at a national index of 71.3. And what is that index? It's essentially saying that we had less transaction activity last month by the tune of 29% compared to 2001. So almost a quarter century ago. Interesting at least to note that population was about 18% smaller back then. So, some 25 or 30% more people probably from that period to today than we have. And yet we don't see 29% increase in transaction volume. We see 29% decrease in transaction volume. And we talk a lot about the Southeast and how hard it's getting hit, but it really is all over the country, as this chart shows. We've got 53% less than 2001 volumes in the West, 74% less, or 24%, I'm sorry, in the Midwest. 38% less in the Northeast. So we have low inventory there still, but not nearly the amount of transactions that are taking place. And then about 14% less in the Southeast. All that plus month over month, a 6% decrease in volume, Jeff. And it's just nasty out there. You've got inventories rising. I think it was Redfin that noted that they have the largest spread between number of sellers in their platform than they have buyers. It was 34% less buyers than sellers. First time that it's been that high or that much of a difference since 2013. So, you've got this, and I'll let you walk us through this chart here. But all of these things just scream trouble in housing.
Yeah, they really do. And, it's interesting when you hear other financial data, you'll talk about inflation adjusted or seasonally adjusted numbers. So you kind of have a baseline comparison. In fact, I'm going to jump back over to this kind of regional breakout by around the country, because to your point, Mark, if you were to kind of population adjust these numbers, they would be even more dramatic, if it was on a per capita basis as opposed to just a month over month percentage basis at the with the current population, because you're comparing to such a far back time frame in 2001. But and I'm sitting out here in the West, and sitting at, 53% of what the, transactions were, month over month, back in that era. And it's just crazy. It really does scream, like you say, boy, there are challenges, that there are problems, and everybody in the real estate space that participates in the transactions, from appraisers doing the valuations to the agents to the lenders, everybody is feeling that much lower, transaction level. We'll talk in a little bit about, equity and like what, where values are at. But regardless of that, if things aren't being transacted, everybody in and around that space is really impacted. And so it just, as you spelled that out, it really stood out that if you adjusted these numbers, it would be even more stark than, what they're showing on this current chart.
Jeff, it occurs to me too, as we're looking at this, that, it's probably some 25 episodes ago that we covered this in some detail, just analyzing the U.S. housing market, from the perspective of affordability with other markets around the world. I just got back from Canada a few weeks ago and kind of analyzing that. And, there's all these mechanisms that Canada has in financing to make homes affordable or accessible in their very high price environment. And so, kind of short-term interest rates, 40-year interest rates, like on an amortization, allowing consideration of the income that the single family property could produce, and also even reaching a point where the actual home ownership is starting to become inaccessible. That the average age of the homeowner, first-time homeowner, is like upper 30s, almost 40. Just shooting up. I think we have similar trends here, maybe not as high, and some just choosing to rent. So this is in Canada, but this is also true in Germany and the UK and Australia, in places all around the world. We've seen tremendous rise in housing prices that we have not seen comparatively here in the US. And so it's a really interesting juxtaposition, because it is a shock. It is difficult for people to afford houses by judgment of where it's been the last 3 or 4 years. But can the dollar afford a house with more expanded financial instruments? I think the world would show us that the answer is yes to that. I hope we don't go that direction, but it sort of feels like everything settles towards that at some point.
That's a really good point. And it's really interesting to me because as you look at a challenge like housing affordability, I think most people agree that having housing be affordable is a desirable state or situation. And was it, I'm trying to remember who it was that we had on. I don't remember if it was Calabria or Pinto, but somebody had made a comment. It might have even been Scott DiBiasio. But somebody had made a comment in a conversation that the government is really good at spurring the demand side of the equation, not so much the supply side of the equation. And the concern that I have is that if we find increasing mechanisms and ways to help people pay more money for a house in the name of housing affordability, and extending from a 30 to a 40-year amortization schedule, or whatever the other mechanisms are, the underlying problem is that the pricing still remains elevated. It's just we're finding creative ways to get around that. Now, the alternative is painful medicine that nobody really wants to take, of allowing there to be a natural price correction when the fundamentals just don't work, where it costs too much to buy a house relative to income levels. So you can find creative ways to bridge that gap while maintaining the current higher price points. I'm not sure that that's the healthiest, long-term perspective or approach to it. But the problem is, if you're not willing to allow the market to correct, then it just continues to get propped up. And tangentially, it's really interesting to see that very same scenario play out on the government budget and government spending side, where there's just a real resistance to taking the medicine of actual painful cuts. And so you increasingly find ways to finance or continue to spend at last year's levels or something. And I think everybody wants there to be affordable housing, but how you go about it has real material impacts in the long-term, viability of the housing market.
Yeah, I think that in all of this change, homeowners or market participants get caught when we change a lot, right? And it is just risky to, trying to make decisions. If you were at the end of 2023 and you felt like, well, it was the end of COVID and felt like it was, the end of the high interest rate thing, but you needed to get into a property or what, it's like, what is the right decision? I mean, I was about to try and time the market in 2018 or 19. I'm a freaking appraiser, and I would have been, what I was planning to do would have been an awful decision, absolutely awful. And so it's hard. And I think all of this, stability with modest increase is where people don't get caught. But, human nature is such, Jeff, that it would lead me to a long-term prognostication that we're going to see 40-year rates at some point, or 40-year terms. I would guess that it would go that direction at some point, but this is all long-term views here, Jeff, and we got problems now in trying to figure out how to deal with that. So I think this second chart that you've got here is from Resi Club. I think it's Lance Lambert that put this together. Thank you, Lance, for doing that and all the stuff you put out there. But we're showing that in a different way, the difference in increasing number of sellers as compared to buyers.
Yeah, a real marked difference just starting, middle of 2023 or thereabouts, where they kind of cross over. It wouldn't surprise anybody, the very onset of the pandemic, there's a real dip in buyers for just a minute, but then it skyrockets and remains elevated compared to the number of sellers out there in the market. But, about a year, 18 months, back from today, you see this reversal of the trend again, where you've got 1.9 million sellers compared to 1.45 million buyers out there. And what's interesting is if those trends continue or hold, I think what will happen in the short term is this natural price correction before there's the need for the 40-year term mortgages or something. Now, who knows if this trend holds, but the way it's looking in the moment, I would be more willing to to bet on that or not. I do just have to share a quick story, Mark. Your comment about trying to time the market in 18, really resonates. I had a conversation with an appraiser even prior to that in 2015 or 16, who had built a spec home, decided to move into it, but same mentality. The market's been going up since this crash and kind of the trough in 2011 or 12. We've seen 5 or 6 good years of market appreciation. I've got this house I just built. I'm going to sell it and get out and make a very modest profit on it. And if he had held on to that thing, it would have been way, way better in the long run. So what you think in the moment with the current data, oftentimes you turned out to be surprised. So, with that backdrop, I'm not certain that the trends will hold, but this graph that Lance put together really does tell a very interesting story of a kind of 180-degree switch or flop from what the reality was, living through the COVID years.
Really a deep buyer's market. And I think with the caveat of the Northeast, they seem to not be going through this trend, but yeah, it's messy. And I think, this stuff is all relevant because today mirrors the last 5 or 6 months and really beyond that, I think even before the election results in November. And here we are, we're just sort of stewing in this level of economic uncertainty on some level. I think there are some segments that are winning, but they're huge wins for big players on a lot of levels. And, the vast majority of smaller players are really struggling. And, this tariff situation and the unknowns there are hurting a whole different segment of the economy. The government cuts are, there's some level of less employment, right? And so we're just sitting here waiting for this uncertainty to go away. And, I don't know if we need to comment too much further about the big, beautiful bill spat now that is going on with we've been trying to guess what Elon was thinking with the bill. And I think, what does he say? It can be big or it can be beautiful, but it can't be both. But we were trying to guess, well, is he leaving Doge and kind of protesting this bill? And I think I guessed that he wasn't. Well, he made that in no uncertain terms clear that he is protesting this thing. So an update, right? So we have that there, but there's just, you've got government spending, which leads to or reduces inflation. You have the continued the same thing being said every week about trade deals, that they're weeks away, and it reminds me of the software developers that when they tell you they're 2 months away, Jeff, they'll tell you they're 2 months away. That is a status. That is not a timeline. And so they are 2 months away for the next 6 months. And when they start saying they're 2 weeks away, they've moved into another status that's a little closer, but it also doesn't mean that they're 2 weeks away. So I kind of read the trade deals in the same way. So it just all of this uncertainty here, I think, is the trend in real estate and housing is not going to change. And I think it's going to get worse until we get some confidence moving forward and some certainty.
Yeah, I think that's right. And there's just a lot of uncertainty, all the way around. One thing that's really an interesting emerging trend is, and this is just anecdotal, but I'm seeing a lot more headlines around, market pricing shifts, for the real estate market than I've seen, in a very, very long time. The CEO of Redfin came out and made some comments around, expecting, and we touched on this briefly, I think last week, but expecting a correction in home pricing of like 1% annually, like, rounding error next to nothing. And yet there are so many headlines expecting, well, there's a lot of uncertainty in the market, in the government, in the economy. That's going to translate or at least have some carryover effect into the real estate market. And I just feels like there's a certain psychology in the markets that once you start seeing a lot of headlines saying, hey, things have changed or things are going to change, it becomes self-fulfilling at some point. And I'm just commenting on what I'm seeing in terms of headlines. And there's a real shift in the mood, the outlook, and the projections, in the last 30 days over what I had remember seeing prior to that.
Jeff, and on that note, if we may have gotten a little glimmer of hope with GDP predictions and numbers. If you could share this last chart that we've got, which is from the Atlanta Fed, which is estimating GDP in Q2 of 2025, you could see drastic improvements or increases in GDP. I think 4.6%. From something like 2.2%, like the general consensus is around 1% growth for Q2 of 2025, and this is percent change in estimate, right? And so, I mean, I don't yet know. I don't know if you do. I don't yet know what would be driving this increase. All that I can imagine is folks scrambling when they are not sure they can buy product or materials from overseas and having to turn internally to do that, because all the building and the multiple trillions of dollars of promised investment, my gosh, how long out is that? That's a long ways away. I don't think that would be affecting us now. Do you have any insights or any guesses?
Yeah, really good question. An interesting topic. I think you're right that the committed investments, it's too soon to see that showing up in the data. My thought as I've looked at this and thought on it a little bit is that it probably is a spike due to uncertainty around tariffs, that there's something announced and then it's pulled back or changed. And, does that drive a spike in demand in the moment because there's not a long-term deal in place? Now, if that is the case, and if there's not kind of clarity around tariffs going forward, I think you'll see this quickly retract, and bump back down, to the 1 or 2% level that it had been. My hope is that there are some underlying strengths. I wouldn't attribute this spike necessarily to artificial intelligence productivity gains, but I do think there are some reasons for optimism or for hope in terms of overall economic outlook. But I guess the short answer, I don't know if I have a great sense yet, but I think that in the coming months it will be pretty telling as to whether this is just a short-term blip or if there's something, more sustainable to it. Of course, I hope there's something more sustainable to it, but I don't know that I would be able to quantify what that is in the moment.
Jeff, I'll use the mention of artificial intelligence just to kind of briefly touch on that topic, which we try to do every so often on the podcast. And we spent a long time talking about it last week. And, I have been thinking about my own comments on that podcast about how, those closest to to the technology. The CEOs of the big language models and the things happening seem to be the ones trying to tell us that things are going on. And I did also need to remind myself not to get too caught up in those headlines, and that fear benefits their business, and there just is reason for them to be pushing the everything's going to change narrative. Who are the people that benefit the most if everything changes? It certainly is the folks that have invested multiple billions into building these language models. So I did want to note that. And two, I've seen a couple of developers out there sort of saying, guys, let's not overuse the word artificial intelligent agents, that are going out and doing things. Automations are great, and really, I think finding their sweet spot here in this day and age, in this economy, I think we're finding a lot of use in that, and have been for a while. And I think people would love to call those things AI agents, and they're just not. I mean, they're in most cases don't require LLMs and all that sort of stuff. They're handy as all get out, and I think very useful and imperative for businesses to put in place, but they're not that. So. I go back and forth, continue to digest, try and balance myself when I get a little excited about something. So I just thought I'd mention that since it was there.
Well, the futurist in you, I do enjoy, kind of seeing what the outlook can be. And, I'm glad you bring that up too, because as I listen to a lot of, the tech CEOs and just those in the space, I kind of have conflicting feelings too, because on the one hand, it's really fun to think what could the future hold with this technology, with the implementation, and without people, kind of the dreamers or the visionaries, you never, have something, a material change come about. But there's also, history is also riddled with people who thought they were going to change the world in a certain way that just never really, panned out or came to pass, or it played out in a different way than what they anticipated. And so I find myself having to do the same thing and take what some of the tech titans say with a grain of salt, and just remind myself that that's possible, that is one potential outcome. But just because they think or say that it is doesn't mean that, even if they want it to be, that's how it's going to play out. And I heard some analysis probably on our collectively favorite podcast, just saying that, hey, when these guys, when Anthropic or someone in that space is out raising funds, it's especially in their interest to gin up headlines, to make kind of bold statements. And it's not that there may be nothing to it, but it also may be calculated, for something that they have going on that that they may or may not be 100% behind or bought into. Just interesting.
You bet. And I right now it seems. I mean, other than like Google search, which I think is still tech, I mean, the biggest impact, it is a technological solution, and the biggest impact is to those that work in tech. Either it is transformational or it is eliminating jobs. I mean, one thing we are definitely seeing is like the Magnificent Seven and beyond are adding margin as they're dropping people. That certainly is happening. And some of that is just kind of austerity coming out of COVID and no longer being able to the Hulu employee or company, if you were a fan of Silicon Valley show from HBO, of just employing people at $1 million a year and putting them on the roof to play video games so that they didn't get hired by other people. But you had a lot of waste. Maybe I'm sure that's quite exaggerated, but you had a lot of waste. And so a lot of that has been cut back. It became, I think even popular among tech circles to do that. So you've got a lot of money being printed by these big guys right now. And so, even in appraisal, I think we find there are moments where appraisers, it's difficult to do what we do. We have hardly seen fee increases for the last 25 years. But I think if we're honest with ourselves, we have seen notable process improvements with technology. And on some level, there is an arbitrage to take advantage of for at least a period of time at the rates, even, fees, even though they might not have moved much over the last 25 years, but couple it with how many you could get done or how quickly you can get a quality analysis done. There are arbitrages there. And, I think the Magnificent Seven are seeing a moment of arbitrage themselves.
Yeah, I think that's exactly right. And I heard some interesting analysis or perspective on that front in particular, because you've got these two schools of thought, right? One, that artificial intelligence and or a combination of automations will take jobs, will replace people in the workspace. But David Friedberg made a really interesting point. And I don't know if it'll play out or not exactly, but his point is, if you can make an employee more profitable per employee, why would you not invest in more employees? And as I thought about that, it really boils down to, does the technology fully replace individuals, or does it augment and support their higher levels of productivity and therefore profitability? And as you boil that down into, whether it's appraisal or anything real estate related, I don't see the technology replacing the practitioners, but if, to your point, Mark, if it can help them be more productive and effective, and profitable, whether to yourself running your own business or within a firm, why wouldn't there be more investment in a more profitable, employee? It was just an interesting way to think about it that I hadn't fully wrapped my head around, but it certainly resonated at some level. On the appraisal front, I remember it used to be that the appraisers were the data gatherers and collectors, in the sense of like going to the county courthouse. I went to our county assessor's office, and one of the commercial appraisers needed to know how quickly lots were selling in a subdivision. So I sat for hours and just made notes of how many lots had sold in each month as recorded. It wasn't information available online. It was very manual and tedious. And so, to your point, I mean, just the natural evolution of technology, I can find that information in minutes where it took hours and being off site to do it, decades ago. And I think it's telling that story of, productivity and efficiency gains, but not completely replacing the individuals doing the work.
It is a feature of humanity, that if we could do the same with less, we aren't just going to sit there and say, oh, I can have a cigar now every day or whatever. We are going to, multiply and now take for granted that and go on to bigger and more things. We just are always seeking growth and innovation. So I think we'll be doing that. Jumping back to housing, Jeff, you had uncovered some interesting data and stats on home equity in the United States, and I certainly thought that would be interesting to share with our listeners today.
Yeah, absolutely. And unfortunately, Mark, you had asked me, well, do they have any graphics to illustrate this? And the unfortunate answer is no, there isn't. So you're going to have to bear with us a little bit on a bit of the numbers. But one of the things that this article I found pointed out was that home equity for owners in the United States is at a record high. It's estimated at $17.6 trillion in home equity that owners have. And this analysis estimated about $11.5 trillion of that equity being tappable, meaning accessible to to borrowers through various lending and loan programs, and that sort of a thing. A couple of things that stood out as being interesting, in addition just to kind of the overall headline numbers, were that in quarter one of this year, the total withdrawals of home equity were up 22% over quarter one of 2024, meaning just as we're seeing some of the pain in the economy generally, there are more people tapping into home equity value in their homes through home equity lines or second mortgages, or that sort of a thing. But a couple of other interesting data points that stood out is the average homeowner has approximately $212,000 of equity in their homes. And additionally, mortgaged homes on average are only 45% leveraged. Now, that's an average. And of course, you're going to have a whole contingent of people that have borrowed up against the very as much as they possibly can, the full value of their home. But it surprised me a little bit that the number or the amount of leverage against that large of an asset class would be under 50%.
You bet. Yeah. Boy, I think about that equity that is out there, and we don't have the numbers of what it was for the country before COVID. Mm-hmm. But I can only imagine that it has nearly doubled in that time. And the first thing that really speaks to, I've got family members as an example that happen to be out of housing during that increase. And, anybody that was not in home ownership before then, this has just made homeownership all that more expensive, because they're not earning equity or appreciation is in taking the ride up. And so I think it's really difficult for folks. It is definitely accessible. And as you look at credit card, consumer debt, at the highest we've been, you see student loans now being required to be paid on. Also interesting that I have seen reports that student loans being required again, and many either not being able to pay them. And I'm not exactly sure how they view the great pause that happened during the Biden administration, but there has been real negative impacts on consumer credit as a result of this, because a lot of people have student loans, obviously, and so there's a little bit of effect there. So nice that home equity seems to be available for many folks to maybe help them through a really difficult spot and transition maybe some of that debt one way or another to the home. But it also strikes me, Jeff, that much of this home equity is done without an appraisal, and we are probably square in the middle of a decline. Probably not all that modest. I don't think exaggerated, but not all that modest. And I'm interested in where that's going to leave us, because I truly don't know. I am biased. I'd like to have an appraisal done. I think it's the safest way. I don't think it's the way lenders are looking at doing this stuff. See it as unnecessary. So those are some thoughts in the stats and the phenomenon that we're seeing here.
Yeah, I'd appreciate the perspective, Mark. I think as soon as you start seeing some losses occur in the home equity space, I've kind of quibbed about this for a long time, but when values were going up before the great financial crisis, people didn't really care about the appraisal. I mean, because the home that you were making the loan against was worth more the next month than when you made the loan, so your risk was very mitigated until things changed and it wasn't. And as soon as values peaked and started coming down, people really cared, because you were losing, the equity or the underlying asset value that you'd made the loan against, and people were underwater, so they just walked away from homes. Now, we've peaked in terms of values now, and we've been kind of bouncing along the top for a while. If that trend actually reverses course, the Redfin CEO thinks that it will, although at a very modest pace. I think you'll start to see a much more scrutinized focus on the value of these underlying assets. And the automated valuation model, the AVM, or whatever was the mechanism to determine what the value of that asset was when the home equity loan was made, may not look quite as attractive or effective. And the thing that those don't capture is, if the home across the street is all of a sudden listed for less than what they're saying, this one is worth. I mean, it's hard to get at that level of granularity and data without an appraiser, jumping in and doing their job, of course. But I think you may see the tide change a little bit on that front as realities in the market start to manifest themselves, and especially if anybody, if banks start losing money and their auditors and regulators are seeing that, hey, you've got more risk in this loan class than you did last year.
Yeah, you bet. You bet. I see the same thing. I hope for the same thing. I hope that they will look to a little bit safer and more cautious analysis of these situations, because you just don't know. And at least today, that's how I feel. And you won't know what you know, I guess, even in a few months ahead. So
that's right.
Very interesting. Well, Jeff, I did 2 weeks ago spend a few days in Montreal at a Canadian appraisal conference and Appraisal Institute of Canada's conference, actually in no way connected to the Appraisal Institute of the U.S., which I was shocked to learn several years ago. But that is the case. They same name, not affiliated. And, it's just interesting to get a glimpse into another appraisal market, one very close to ours, obviously, but my goodness, is it different? It's essentially a couple of handfuls or several handfuls of lenders and 6 appraisal management companies, and just not nearly the level of regulation that we see here in the U.S. I sort of, from the moment I saw it, thought that the Canadian appraisal market was a lot like the U.S. appraisal market in the 80s. Of course, I was 10, I guess, during that time, Jeff. So I don't have firsthand experience, but what go to an appraisal class and an appraiser will tell you what it was like back then, pre-certification and all. But yeah, it's just interesting to see the way it works, and I think it functions really well. It's very much relationship driven, and the Appraisal Institute, the trade association there, is really the assigned regulatory authority. You kind of need to be a member of one of several organizations and get designated to then do appraisal work in the country. And it is that organization that kind of runs whether or not who is an appraiser and who isn't. So it's just a really fascinating look. I think it would be a fun place to do appraisal work in. Given the very strict world. I mean, and I certainly would say that we have advanced from that on certain levels, risk assessment and in many things, data. Can't think of the word, but data similarity. The uniform appraisal data sets and on and on. So it creates problems, and you see problems there by not having standardized data formatting. So it's just really interesting. I just thought I'd share the experience. I had a great time there, and it's just a very different market. I'd say that in the U.S. For a while now, we all went through COVID, Canada and U.S. for sure, and we have a problem of too many appraisers and not enough work in the country. I find them to have the exact opposite problem in large ways. It's a lot of work and not enough appraisers. So it's just my little perspective, spending a little bit there, but enjoyed the time, enjoyed the people, and interesting to compare the two.
Yeah, it really is. Yeah, I would be lost trying to figure out what a price per square meter was. Some of the nuanced differences would be, take a little bit of getting used to, but I think we just take for granted in the U.S. like the licensing paradigm that there is. That was implemented in the early '90s, coming out of the savings loan crash, and appraisers got blamed for that. So they said, well, we got to do something about this, and here comes licensing, and it is interesting. I think a lot of people would be surprised to know there's not a government administered like licensing structure in Canada, but it's what exactly, I think you paint the picture well. It's what the U.S. had pre-licensing. It was professional associations and designations that say, hey, this person has taken enough training to be qualified to be an appraiser. My dad tells the story of when he got started, there wasn't licensing, and he was going to buy somebody's firm, and then that kind of a weird story as to why that didn't happen. But at the end of the day, he realized, well, there's nothing preventing me from just saying I'm an appraiser and hanging a shingle and then starting to act like an appraiser, while affiliating with associations and stuff. And so that is, at least at some level, like kind of the lived reality in Canada. Is interesting for sure. And it's interesting, too, Mark, that they have the reverse problem of not enough appraisers for the volume of work up there, from what we've had. And I suspect that licensing, how long it takes to get licensed and kind of the inelastic nature of the relation or of the appraiser population is a factor there. Do you have a sense, you may not, but do you have a sense of what it takes to get designated up there? Is it a significant time constraint, or do you have any idea?
No, I think it's about maybe a little bit less, but it's about what we have here. Of course, the residential appraisal itself is a lot pared down from what we do in a standard 1004, and certainly what we're going to do in this monstrous 3.6 situation. So yeah, it's I'd say it's about the same.
Yeah, interesting. Well, and as you allude to, go ahead.
Yeah, well, there is so with that there is obvious benefit to the regulatory overlay added to our appraisal industry and market and real estate mortgage market. Essentially, there is obvious that it is also obvious how far the pendulum has swung, how too far the pendulum has swung the other way with our nauseating regulatory environment as compared to the Canadian market. I think everybody in the U.S. would think appraising in Canada is a breath of fresh air, because it just is. It's a very different thing, and you and I have been dealing with this a lot, really crescendo during the Biden presidency, which we talked a lot about on this podcast.
You bet. Yeah, you bet. And we may have a guest come on talk a little bit about some of the differences, because the problem even with the licensing is that you've got the appraisal foundation and the qualifications board that puts out the minimum standards, but many states have many and different overlays on licensing in their particular state. And so you don't even have consistency from one state to the next as to what it takes to become an appraiser. And so, maybe a bit of an interesting conversation, but it's very interesting to me how, the same profession operates differently, just across the border, up there as opposed to down here.
Yeah, so kind of nearing the end of the show docket here. Just a bit of a fun story that we touched on a few weeks ago, which was the newest Pope, Leo, with some Roman numeral after his home in Chicago was up for sale the moment that he was selected. The sellers took the home off the market, maybe a little bit shocked that he lived there. I'm not sure they knew that at the time. And now, Jeff, there is conversations about the city condemning the house. What do we know?
Yeah, it was interesting. Well, I will just note, Mark, that one of the benefits of having a very small contingent of listeners is that if we've offended all of the Catholic listeners that we have, we won't see that big of a drop off in viewership because there's not a big one to start with. But no, it's been interesting to see. I saw the headline about this. When it first had hit the market, and then it came out. I think part of the issue was that until he was actually elected and became Pope, it was just not a figure with as much kind of publicity. But it's interesting to see that the local municipality is saying, hey, we want to condemn this property to preserve it as a historical site or something. It's just so they're basically saying, hey, this thing's coming up for auction next month. They're telling the auctioneer, you better tell them that that if somebody bids on this house, they're not going to be able to have it for very long because we're starting the process of eminent domain of condemning the property to preserve it. And there's been some, debate, on a very small scale as to, is that the proper use of eminent domain? And is that even within the legal rights that the municipality has? It depends on how you argue it and how you look at it. But interesting, that there's that level of, I think, desire to preserve it, for what it is. So, we'll see if it turns out to be, some historical site that you can go visit, or if it gets sold on the open market and it's just somebody else's house that happens to have the notoriety of having housed the future Pope at the time. But it is interesting how, I think you run into this with celebrity type housing, where, this person lived there at one point, actually impacts the, potentially the desirability of that property in the market.
You bet. Yeah. Well, intriguing, if nothing else. We'll see what they end up doing with it. A museum of some sort feels like the right thing to do. I don't know. So, well, Jeff, enjoyed it this week. Continues to be these interesting times, and look forward to the next.
Yep. Yeah, interesting indeed, even if it's uninteresting people that are talking about it on the Market Moves podcast. But yeah, a lot of fun, Mark. So until next time.
Bye-bye.